Why is Canada's interest rate strategy changing? Just a few months ago, in June, nearly every economist said the Bank of Canada to continue cutting interest rates, but they predicted the pace would be cautious and slow. Realistically, we were looking for two or three of these quarter percentage point cuts in 2024. Our best guess was that it could take up to 2 years ultimately to get back down to the around 3%, which the bank considered to be normal. Canada was actually one of the first countries to start cutting rates a few months ago because the central banks took a look at the national economy and saw rising unemployment, stalling GDP and productivity at an all time low. They decided the economy needed a boost. We need growth and job creation to start picking up. But the plan was to take things slow because inflation still wasn't fully under control. Cutting rates too quickly risked driving inflation back up, and according to the analysts we spoke to, they were concerns about falling too far out of sync with the US. However, this week everything changed. Headline inflation cooled to 2% in August, returning it to the Bank of Canada's target for the first time since 2021. Meanwhile, in the US Federal Reserve delivered a jolt to the economy by cutting benchmark rate by half a percentage point. So while our neighbors to the south is cutting rates aggressively, we wanted to know if Canada could follow suit. Interest rates in the US had been stuck for a long time, with the last significant drop occurring when half the country was under pandemic lockdown. This week's announcement by the Fed was big news, not only in the US but in Canada too. US Federal Reserve Chair Jerome Powell announced a sizable half percentage point cut to the US interest rate. The economists say this will likely spur the Bank of Canada to make further cuts to its interest rates as well. One of the reasons that the Bank of Canada has been sticking to small quarter point cuts, even as the economy teeters on the edge of recession, is that falling too far out of sync with the US could create problems. If the US hadn't started cutting soon, we might have seen the Bank of Canada pause its rate cuts. Not because we're working in tandem with the US, but because failing to move in alignment can be bad for monetary policy. When interest rates go down, it makes Canada less attractive to investors. If the US keeps the rates high, investors may pull out their money out of Canada and move it to the US, weakening the Canadian dollar. A weaker Canadian dollar means everything we import from the US costs us more, including gasoline, which is the price in US dollars. Higher gas prices contribute to inflation, so cutting rates without US doing the same could be counterproductive. When the Fed shifted from cautious to aggressive this week, cutting half a percentage point and signaling more cuts to come, it gave the Bank of Canada room to maneuver. With the US now easing aggressively, the Canadian dollar may strengthen, giving the Bank of Canada the confidence to continue cutting rates without worrying about the inflations resurfacing through the exchange rate. Another reason the Bank of Canada might mirror the US rate cut is the signal to send about the strength of the US economy or the lack of it. Central banks generally cut rates because the economy needs a boost and the US economy is showing signs of slowing down. As they say, when the US sneezes, Canada catches a cold. If the US economy slows, so will Canada's, giving the Bank of Canada more reason to accelerate its own rate cuts. That brings us back to the Bank of Canada's primary focus, inflation. The central bank's main job is to bring inflation under control, and while the economy may be struggling, inflation is still the number one concern. 2 years ago, Canada's inflation rate was 8%, and the prices were surging. The Bank of Canada raised interest rates repeatedly, which made mortgages, car loans, and lines of credit more expensive. People started spending less on everything else, and less demand led to lower prices and eventually lower inflation. Please leave a like and a comment if you have something to say about that. The plan worked, but now there are concerns that it worked too well. With inflation down 2%, the bank is worried it might actually fall behind their target, pushing the economy into recession. What's your thoughts? Leave a comment. This is another argument for speeding up rate cuts. The economy is already being slowed by high interest rates, and with inflation near the target, there's less need to slow things further. In fact, the unemployment rate in Canada has been rising, reaching 6.6% last month, up under 5% 2 years ago. Meanwhile, the GDP growth has stalled, well below the bank's foreclosures. All of this has the economists predicting the next few rate cuts could be larger than expected. Some analysts believe we could see half percentage point cuts at the next two meetings in October as well as in December, meaning a full percentage point drop in just a few months. Barring any major changes in the economy, it's looking like we could reach a neutral interest rate much sooner than expected. The neutral rate could even be lower than previously thought, possibly as low as 2.25% by the end of 2025, which could stimulate the economy. There's one caveat, however. If lowering mortgage rates caused a dramatic bounce back in this housing market, the inflation rising again, the Bank of Canada may need to adjust its approach. But for now, we're looking to buy a home or hold a mortgage. In today's interest rates, outlook is probably welcome news. Please leave a comment. We'd like to hear your thoughts. Have a great day. See you in the next video.